Hey guys, Dave Keller here with Market Misbehavior, and welcome to our latest episode of Chart This with Dave Keller, coming to you from a kind of wintry day here in Rochester, New York, doing the East Coast trip with my daughter, looking at some colleges. Good to be catching up on the markets, though. Spent a little time here reviewing charts going into the close. And as I checked on through the course of the day, clearly a big time risk off day. Now, we've talked about the danger of days like this popping up since the Hindenburg omen has had successful firing in the last couple weeks. I've heard a lot of people talking about how the Hindenburg omen is a meaningless indicator. I would respectfully disagree with that take. For me, it tells me to be wary and ready and vigilant for days like today. Distribution days which show a clear risk-off rotation. Another sort of lesson as we get into the charts here is remembering that days like this remind you, buy the rumor, sell the news, right, is a classic trading maxim. So, the market kind of pricing in, a lot of optimism around the government shutdown lightening up. Now, all of a sudden, the shutdown finally resolved as of last night or early this morning. And sure enough, big time risk off move. What concerns me is once we get sort of the updated calendar for economic data coming over the next couple weeks. So we haven't had any real jobs data or inflation data or anything that might help us get a better sense of what the Fed governors may be thinking going into the December meeting and certainly into the beginning of 2025 or 2026. We haven't had any of that data. And once we do get the calendar and once we do start to get that data, the danger is if it shows that the economy has not been growing particularly well, if there are causes for concern, I think that's what could weigh on the market very, very quickly. All right, with that in mind, here's what we're going to do. As always, kind of a normal session here. We'll talk about the market recap. We'll look at some of the deterioration that we observed here through the course of the trading day, finishing near the lows of the day. We'll look at the heat map. And as you'll see in a moment, not great because a lot of distribution. Breadth numbers were not particularly good, so it wasn't just growth, although growth was definitely at the bottom of the list. And then I've selected some charts to update. Big change in sentiment today, by the way, looking at the AAII survey. All right, let's take a look at the major averages. We can see the S&P finishing down 1.7%. The Nasdaq composite down even more, about 2.3%. That's the worst performer here on the front page. Mid caps and small caps, nothing was immune to today's distribution. All of those down over 1.7%. Best performer is the New York Stock Exchange index, but out of the major indexes, Dow and the S&P both down about 1 2/3%. The VIX actually spiked above 20. It got as high as 21 and change in the last hour of trading. Going into the close, there was this big kind of strange downward move in the VIX, which finished right exactly at 20, according to stock chart. So that's 2.5 VIX points higher than where we closed on Wednesday's session. Here's Wednesday's close at 1750. Today we got as high as 21 plus. We ended up closing right at 20, although it looked like going into the close, we're going to be up in the 20 in a 20 handle somewhere. So holding into there. So we were right at the threshold, in my opinion, between a low volatility environment and a high volatility environment. VIX spiking above 20 is one of the classic red flags for a bull market phase. That implies an injection of fear, an injection of uncertainty, and usually a distribution phase coming very, very soon. Bonds generally actually drifted lower today, so it's not like bonds were great because stocks were struggling. Stocks and bonds both moved lower. Very few things were actually up, although I'll give you a hint. It's on the commodities page where you see some things actually moving to the upside today. So the TLT, which is the bond ETF that we track, down 0.8%. The dollar index down slightly today, and rates generally moved higher. The 10-year yield finished today just above 4.1%. Looking at the commodity space, gold, silver, both in the red. Crude oil slightly higher, natural gas slightly higher. So Gold and silver, which actually were in the green earlier in the day, afternoon, actually rolled below the zero level. Gold finished lower 0.8%. Silver finished lower 1.9%. So not much, but the only things I'm seeing in the positive slightly were crude oil prices. Energy actually ended up having a pretty decent day. Another concerning development we've been tracking has been the deterioration in cryptocurrencies. I think as my guest, latest episode of the Market Misbehavior podcast, Andrew Thrasher and I talked about cryptocurrencies as sort of a petri dish for investor sentiment. All right, this is a set of markets that don't really have a lot of fundamental data to speak of. And so the deterioration that we've been observing in Bitcoin and Ethereum, imply a lack of speculative pressures to the upside, right? A lack of risk on kind of vibe. Currently, as we're recording the show, just after the U.S. equity market closed, Bitcoin rotated below the previous close, currently trading around 98,500. That's down about 3% from yesterday. Ethereum prices, even worse, down over 7%. As you can see here, all 10 of the top coins tracked on the stock charts platform in the red. Looking at the 11 S&P sectors, what we call sector breadth, really not good. And we'll start at the bottom here with two of the largest sectors and two of the growthiest of the growthy, technology and consumer discretionary, both down about 2.5% to the day for the day. Industrials were third from the bottom. The XLI was down 1.5%. Only one of the S&P sectors really finished positive, and that was energy, with those crude oil prices higher for much of the day and did finish slightly higher using the USO, which is the crude oil ETF that we track. Energy was up about 0.25%, which is saying a lot on a day when almost everything was down. Consumer staples basically exactly at the zero level, unch from yesterday, and healthcare just a rounding error below the zero level. So the only things that really were okay were energy, consumer staples, and healthcare. Everything else was down, and the growthiest sectors of technology and consumer discretionary really strong to the downside. As a reminder, one of the ratios that we track often is what we call the offense to defense ratio. Offense is things you want, represented by consumer discretionary. Defense, things you need, represented by consumer staples. That ratio went down pretty good today. That chart of consumer discretionary versus consumer staples, what we call our offense versus defense chart, we'll look at that in a little bit, and you'll see that actually took a big step lower today. Breadth conditions, which had been a little more constructive earlier this week, taking a big downside turn today. On the New York Composite Index, 76%, 77% decliners versus 22% advancers. That's about a 3.5 to 1 ratio. On the S&P Mid-Cap Index, about a 4 to 1 ratio. 80% of that index was in the red, about the same for the Small Cap Index. So breadth taking a big negative turn today as most things came down. Look at this, though. Out of all the Magnificent Seven stocks to report on, the one that was actually positive has been, without a doubt, the worst of these charts here in the third quarter. Meta, which actually just finished slightly higher, 0.1%, so not much, but holding its gains, just holding in there while the rest of the market was rotating lower. Apple and Netflix both down slightly, less than 1/3%. So not a bad day given the deterioration in the major benchmarks. The real pain here: Tesla down 6.6%, Broadcom down 4.3%, Nvidia down 3.6%. So if you're all bulled up here, I would argue the weakness in semiconductors, particularly a day like this with Broadcom and Nvidia both taking big steps down, that doesn't feel bullish to me. That feels more like a risk-off type of move. All right, we'll continue on here looking at the market carpet. As a reminder, we welcome your questions, appreciate your questions as you're watching the show as we talk through markets and charts and heat maps. Use the comment section on our YouTube channel. Drop any questions that come up. We'll do an all mailbag episode on Friday, and we'd love to feature one of your questions on the show. All right, let's look at these the heat map here. Obviously, the left half looking pretty weak, and particularly the growth sectors of technology, upper left, consumer discretionary, middle top, and middle bottom communication services. But it's not all of the names, but particularly in consumer discretionary with Amazon and Tesla, in communication services with Alphabet. It's the biggest names that struggled the most. Also in communication services, I did grab the chart of Disney because a gap higher yesterday led into a gap lower today as earnings were kind of a disappointment. The real story, I would say, with today is a couple things. Number one, obviously a big step back in technology shares. Nvidia, Broadcom, Oracle, AMD, Palantir, most of the semiconductor space all had pretty good down days of 3 to 4%, even more in some cases. That's what's going to weigh on our benchmarks. Even if everything else on the heat map was kind of neutral and slightly green, if the stocks that I just mentioned are all bright red, down 3, 4, 5%, the indexes are going to be down pretty good because those are the juice. Those are the biggest weights there in the S&P and certainly the Nasdaq 100. In the lower left, concerning rollover in some of the financial stocks. So charts like JP Morgan made new all-time highs earlier this week. Same with Bank of America and Goldman Sachs. These are all stocks that have been in primary uptrends and undeniably still remain in primary uptrends of higher highs and higher lows. But again, the concern I would have as we've observed the strength in U.S. and certainly non-U.S. financials like European charts like DB for Deutsche Bank, if those start to struggle and pull back from resistance, that could be a real issue. All right, one other sector I wanted to talk about, by the way, and then we'll get to some charts here, is the industrial sector. And again, What's interesting about a day like today, it's the leadership, right? The previous leadership. And this is one of those big structural changes we talked about. In a new bearish phase, the heroes of the previous bull market often become the villains in the next bear market. And I think we're seeing that, at least today, we're seeing semiconductors, which have been, some of the strongest charts in technology, if not in the benchmarks as a whole, pulling back today. Financials, particularly the large banks, which have done quite well, struggling today. Industrial names like Caterpillar and others, which have made new all-time highs in the last month, pulling back off of those previous highs. So I think we're seeing enough deterioration that I'm concerned by what I'm seeing before. Now, to be clear, some of these charts are still great charts, right? These stocks making higher highs and higher lows are still constructive charts, but days like this remind me that there could be a downside move here, and to focus on lines in the sand, focus on higher highs and higher lows, and when that pattern would change. When stocks don't hold support that you think that they should, that's when you really want to be concerned here. All right, to finish off, let's look at some charts together. We're going to start with the daily chart of the S&P 500. As a reminder, if any of these charts elicit some questions in your mind, please take a moment on our YouTube channel, drop a comment there with your question. We're planning an all mailbag episode on Friday, and we'd love to answer one of your questions. As part of that discussion, here's that daily chart of the S&P 500, higher highs and higher lows. This trend channel that we've been covering, representing a consistent uptrend phase over the last 4.5 months. Today, we have closed below the lower trend channel. That's actually the first time since I originally drew these lines a couple weeks back or a month back, however long it was. It's the first time we've actually closed below that trend line. Now, similar to what we saw here in early November, this was last week, we tested the 50-day. We traded below it, but did not close below it. We're actually currently just slightly above that 50-day moving average. So we're closing outside of the trend channel since the 50-day is right there. Since the 50-day has served as support so many times on the way up, I would look to see if that can hold. If not, and if we get a valid close below the 50-day, then I would be looking for follow through to the downside and see if there's further distribution next week. Also, we'll be keeping an eye on the RSI for now, still in a neutral range between 40 and 60. As long as we hold 40 during this little tactical pullback, I would say, trend is still pretty good. We're still making higher highs and higher lows. That's what this trend channel represents. However, if we would close below the 50-day moving average, even worse, if we would get below our important line in the sand at 65.50, and if we would break below an RSI of 40, those three things happen, I will tell you this is a distribution phase, and I will be avoiding it and starting to lighten up on equity positions for sure. Looking at the breadth conditions, we highlighted yesterday how the breadth had started to improve through the course of this week. Over 50% of S&P stocks above their 50-day. until today. Thursday's down move takes that number back down to 45%. If we failed to get above 50% and hold that here, that would be a big check mark in the negative column, I would say, for equities and for other risk assets. Volatility starting to get ugly here as well, right? The VIX, known as the fear gauge. I would say better description is the uncertainty gauge, because I would argue at this point it's all fear, right? When the market's going higher, it's FOMO, fear of missing out. When the market's going lower, it's fear of losing everything, what we might call folie. And I think VIX tracks that that latter fear, right? The fear of losing everything. This is a panic gauge, or a measure of anxiety, an uncertainty gauge. The markets like kind of knowing what's going on. Markets like low volatility uptrends. The markets do not like big question marks on the sustainability of the uptrend. And when the VIX spikes above 20, that for me is something I've just learned as a very basic indicator that things are starting to be not so great and people are starting to get nervous. The last time the VIX spiked above 20 was in mid-October, about a month ago. Remained above there for about a week and a half. That was during that pullback as we pulled back here to around 65.50. That was the last time we tested that support. So if the VIX would push above 20, that would represent an elevated risk of further deterioration. Maybe put that 65.50 level in play. Quick comment on sentiment readings. A lot of the weekly sentiment data we'll review on Thursday, because it's updated Wednesday into Thursday. So Thursday after the close is a good time to do a weekly check on sentiment data. Another big downgrade in optimism here. 2 weeks ago, we were around 45% bulls. Last week it was around 38%. This week it's down to 32%. So the last couple of weeks, about 10% of respondents in the AAII survey were bullish and are no longer bullish, or either bearish or now neutral. Last week, we had no change in the bears. The bears were still around 37, 36%. This week, all the way down to 49% bearish. The last time we went below 50% bearish, by the way, was here right after the February peak, where we had a huge increase in bears. We went well above the 50% level, and that was the beginning of this sort of waterfall decline into the eventual low in April. I'm not saying if we see over 50% that's guaranteeing another move like that, but it does tell me there is now an elevated risk, a non-zero risk, that we have a big sell-off as investors start to panic. The problem with panics is when you start selling off, people start getting nervous, they start unwinding position. That creates further deterioration, that creates further panic, that creates further unwinding positions. This is that feedback loop that often can lead to pretty significant sell-offs when you look back in market history. Name exposure index, actually not much of a change, down slightly to 88%. When I look back through the long history of the name exposure index, this is still a pretty decent number. That tells you money managers, and at least in this survey, not really lightening up too much, still have their foot on the accelerator. And I'll let you know maybe next week if you would see further deterioration. I would expect a big pullback in that number. If you look at what happened after the February peak, once the price started to rotate lower on the S&P and the Nasdaq, you really started to see lightening up in the weekly results of this survey. For now, over 80% is still pretty decent position. So the AAII survey certainly taking a much more significant pullback than we're seeing in the name exposure index. Cryptocurrencies do not look bullish, and I would say at this point that is not an opinion, that is more of a factual reflection on the trend. How can I say that it is a fact that the chart is not bullish? Because it is not going up, right? It's bullish when charts go up, it is not bullish when they don't. Bitcoin is in a primary downtrend of lower highs and lower lows. I would argue since the early October peak, we have a pretty consistent pattern of lower highs and lower lows. We've had counter trend rallies that have stalled out at moving averages. This last counter trend rally did not even get back to the 50 and 200-day moving averages, currently just above 110,000. Currently, we're just below 99,000, which means we appear to not be holding the 100,000 level, big round number, the ultimate support potentially for Bitcoin. What's next? I would argue, given this deterioration, given the breakdown, given the fact that we retested this support range that we've been talking about for many, many months, served as support back here in August and September, and again in October, failed, and now we retested and rotated lower. I think 93,000 is the next downside objective. At that point, I would be more than happy to revisit this one. But for now, given the weakening momentum, the weakening trend, and the clear failure to hold support, Bitcoin is in a primary downtrend. Personally, I've been lightening up on my positions in Bitcoin ETFs over the last, really the last month or so, as we've seen the initial drops. But certainly in the last couple weeks, I'm pretty much out of most of those at this point as I unwind that position. All right, offense versus defense. This is a ratio of a consumer discretionary sector versus the consumer staples sector. We're going to talk just briefly about sector relative movements because I would argue we've already had all those leading indicators of weaker breadth and weaker momentum. What we now look for are structural changes, changes in leadership. And what that means for me is whatever worked really well in the previous bull market should start to not work very well. And I think we're starting to see that, at least in some ways, at least in some tactical ways, in the month of November. Here's the offense to defense ratio, which going into the end of October, clearly favoring offense. In November, clearly favoring defense. That's the cap-weighted version, which means Amazon and Tesla, their weight is severely high in the XLY. If you look at the equal-weighted version, the concern here is it never confirmed that high around Halloween, right? We had the highest point here in late September, lower high in late October. Now we're continuing in a downtrend. These ratios get below that October low. I think that would be a big downside confirmation based on that offense to defense ratio. Has been looking pretty well for pretty consistently off of the April market low. All right, let's look at three charts that I review often, looking at relative strength. Each of these charts, first the three growth sectors, technology, communication services, and consumer discretionary. For each of these series, we are looking at the relative performance of that sector versus the S&P 500. If the line's going up, the sector's outperforming. If the line's going down, the sector's underperforming. Let's just focus on this last little section, which is the month of November. In the month of November, technology has underperformed. Communication services has underperformed. Consumer discretionary has underperformed. Looking at the three value sectors, industrials kind of sideways, holding in there. Financials have been outperforming. Materials have been outperforming. Energy has been outperforming. Here are your four defensive sectors. Utilities basically flat, slightly higher. Healthcare outperforming. Consumer staples outperforming. Real estate outperforming. So while a lot of these things in absolute terms are pulling back, on a relative basis, we're starting to see an improvement in the value sectors and the defensive sectors and a deterioration in the relative performance of growth sectors. This is what I would expect if this is more of a major top that we are experiencing. The more that those rotational themes continue, I would argue the more that it validates a risk-off sentiment for stocks. Final chart here, Disney. I just want to point out, again, I wish I could tell you the technical analysis was always just perfect, and it never didn't work, right? This is why, and I would argue this is not technical analysis not working. For me, it's a reminder that you need good money management. This is the chart of Disney. We've highlighted and we've talked about this chart bouncing off of the 200-day moving average, kind of in this sideways range. Tuesday, a breakout above the 50-day moving average for the first time since, what is that, early August? Yesterday on Wednesday, a follow-through day. So by my read, that is a short-term buy signal, right? A short-term bullish signal as we've broken above moving average resistance and continue. We had a nice follow-through. The challenge with owning a stock into earnings, it is often a binary outcome. This is something you need to be mentally and emotionally prepared for. I always tell people with the chart like this, remember, when you buy a stock, you are taking on a bunch of risk, and that is why you have the opportunity for the superior returns that equities have provided over many, many decades. You get those opportunities for greater returns because you were accepting greater risks. If you want no risks, buy a treasury bond. That's a pretty risk-free way to park your capital somewhere and just gain a regular income component. But if you buy stocks like Disney, you are accepting what's called earnings risk, which is the company misses earnings, the stock's going to gap down pretty good. closed down about 7.8%. It was down a lot more. Got all the way down to $105 a share before trading up just above 107.50 going into the close. By my read, this chart is now broken. If it can regain the 200-day moving average, I might evaluate it as a potential recovery name. But for now, the gap below the 200-day is a concern. The RSI is right at 40 now that we've gapped lower. Further deterioration Friday into next week. Disney becomes an even uglier chart. That's the update on where we're at today. As a reminder, we've been talking about things like the Hindenburg-Omen, the leading indicators like deteriorating breadth and momentum. Now it's all about rotation. I would argue incremental data that we saw today, much weaker breadth, weaker performance in some of the leading stocks and sectors, particularly technology, financials, industrials that have been doing so well. Those rotations away from those leading names, while those charts are still good, more and more days like today would really validate more of a risk-off environment here continuing in the month of November. What do you think here? What questions come to your mind? Get them in now. Use the comment section below our YouTube video, and we'd love to feature one of your questions in our next mailbag episode. That'll do it for today. I'm Dave Keller with Market Misbehavior. Thanks so much for watching me here today. Thanks for being flexible as I do some different formats that I can swing from my hotel room here in Rochester. But for now, I'll say have a wonderful evening. Wish you the very best. And remember, it's always a good time to own good charts. Take care, folks.